So good afternoon and welcome to Level39 TV. Ben Goldsmith here, chatting with Meb Faber this afternoon, who is the CIO and co-founder of Cambria Funds. Meb is an expert. He's been on CNBC this morning talking about everything trading. But what I want to know from Meb is the hot issues where tech and trading come together. So copy trading, that's something that's hot on the minds of everyone. You, Meb, you co-founded or founded an organisation that was involved in copy trading a few years ago now. Can you tell us about your involvement there?
This goes way back to 2000, where we used to look at a lot of these hedge funds, and I would say, these guys are way smarter than I am, they're better capitalized, they spend 24/7 thinking about these stocks. Why wouldn't we just follow or see what they're doing? And so in the US, they publish the holdings every quarter. There's a delay, but there's holdings every quarter. And so I said, being a quant, I'm gonna reserve my opinion until we see the data. And what we did is we went back and started recreating, had you bought the stocks when they become public, so including the delay, for a lot of these managers, it actually works out great. And the managers you want are the managers that aren't that active, they don't have super high turnover, but rather just the pure stock pickers. Warren Buffett comes to mind. There's a very famous paper that came out and said, had you just bought what Buffett bought when those stocks were public, you'd beat the market by 10% a year. And that's a monster number. And so you could do these sorts of things, but most investors aren't willing to either spend the time or the effort to research these ideas, but we think there's a lot of value there.
What you worked on seems to be a solution by investors for investors almost, but do you have any opinions on companies like Utorrent, who are a Level 39 member, that almost open up very complex stock market traders' portfolios immediately to Joe Public?
Most of the technology innovations that are designed for retail traders to trade more usually end up horrific for the retail investor because they're their own worst enemy. Many are not professionals. They have a lot of emotional biases and do a lot of essentially dumb things when investing in trading, one of which is trading too much. But it's a really challenging space where you end up with a lot of churn on the investor side. Do a few make it? Sure, probably. But we think in general, and if you look at a lot of the research in the US, investors spend more time deciding where they're going to go to dinner than where their retirement investments or how they trade. So a lot of it is simply arming someone, with a more powerful way to lose all their money.
That's a very interesting way of putting it. So do you think things like Utorrent may be able to almost needle out the bad traders because it's making everything public?
Potentially. You have a little bit of the survivor bias problem where, essentially if you have enough monkeys flipping coins, there'll be some that had heads 20 times in a row. And then you also have different market environments, right? Where some may shine and look brilliant, then all of a sudden things change and they look terrible. But it's really part of a larger question, which is active management possible? Is finding traders that can beat the market and then identifying them ahead of time to outperform in the future? Is it possible? We think so, but it's certainly not a hobby or something people can do, I think, with kind of just a hobbyist sort of research. It's a very involved process, and even then you can get it wrong.
So given what you've just said, do you think that the whole business of trading on the markets is a very human process? Because at the moment we're almost seeing a robots versus humans debate with a lot of robo-trading developments being made. Is an intelligent system as good as a human? Will we see the man dying out?
It's good and bad. No matter what, humans are programming the robots. So if you're looking at time frames, that humans have the behavioral biases. So very much the emotions and greed that play out in markets, and we operate on a much longer time horizon. Some of our funds only rebalance once a year. A lot of those emotional biases are what we're taking advantage of. So investing in a lot of the cheapest countries in the world right now, the Greeces, the Russias of the world, a lot of emerging Europe, that's taking advantage of all the investor biases where they're selling at the bottom, which is what most people do, as well as buying at the top when things are good. Technology in many cases simply makes it easier for people to make bad decisions. However, coming up with a objective investment process, I mean, buy and hold's a great example, if you go through with it, that is very systematic. And if you have a computer program or a brokerage or something that will help people enact that and put it into work, that's fantastic. The question comes after they lose 10, 20, 50% of their money, do they then go shut off the computer? Do they then go shut off the automated service? That's the same problem as having done it yourself. So the biggest challenge is having a process and sticking to it.
You're almost saying that even if the robots come in force to the capital markets field, it'll always be humans deciding when they use them or not.
It's very difficult to explain to people the real pain of losing money, especially people who have not been through it. And people often will talk about risks. They'll talk about, I'm really aggressive. I have a huge, super high risk tolerance, until they've lost 30, 50% of the money they've been saving up for college or for their children's, or for retirement. That's a very real pain. I mean, people use a different part of their brain when they're losing money. It's the flight response. And so until that's happened, computers and systems become irrelevant because people simply say, they throw up their hands, I can't take it anymore, I'm done. We firmly believe in the objective, computer-driven, quantitative process, but you have to still take into account a lot of the emotional input on the human side.
That makes a lot of sense. And you've mentioned before in previous interviews that I've seen, there's a tendency to buy when there's blood on the streets, and you've mentioned the situations in Russia and Greece and buying at the bottom, selling at the bottom. Can technology somehow make this process less emotional?
It can make it less emotional. It doesn't mean people will do it, So we are the ones buying those assets from all the people that are emotionally selling it, and our process is systematic. It doesn't mean Russia can't go down more. It doesn't mean that the U.S. isn't going to go up more. But historically, investing in value is a great example. Has worked in every country around the world, across countries, and it's not only doing something systematic like investing in what's cheap. It's also systematically avoiding what's expensive, which is just as important. But coming up with these sorts of portfolios, these sort of ideas where you move, last thing I want to do is be buying Russia and Greece right now. You got to essentially close your eyes, hold your nose, and buy them because it's a very emotionally different, because what often happens with markets that are down a lot or a value approach is that all the headlines are terrible. There's 1,000 reasons not to invest in these countries. Russia's doing a lot of things inflammatory politically, but that's the risks you want to take. Templeton had a great quote, don't ask me where things are best, that's the wrong question. Ask me where things are most miserable. And that's where you want to be investing.
I think that's quite a nice and almost philosophical note to end on. Thank you very much, man, for popping in. It's been
Thanks
brilliant.
for having me.
Thank you. Cut that bit.
Cool.
Awesome. Meb, thank you for taking the time.
Piece of cake.
I'm glad it was
Yeah.